Hello, my name is Charles Smith. I'm a retirement plan advisor at First National Bank of Omaha, and I want to spend a couple of minutes going over some recent IRS guidance with respect to distributions and loans from retirement plans to individuals who were impacted by the coronavirus. As you may recall, in May, the CARES Act was enacted, which allowed for increased distributions and favorable tax treatment for those individuals who had tested positive for the coronavirus, their spouse had tested positive, or they had experienced adverse financial consequences, and specifically from being laid off, being furloughed, a reduction in hours, or the closure or reduction of hours of a business that they were operating. This new guidance expanded those adverse financial consequences that would allow someone to qualify as a qualified individual under the CARES Act. They now include a reduction of income, including self-employment income. So maybe for a participant who's working the same number of hours but for less pay, or a self-employed individual who is billing their clients less or receiving less income from their clients, they would be eligible for the favorable tax treatments under the CARES Act. The most important is they expanded it as well to any spouse or member of the household living with the participant. So if a child or a spouse in the household has a reduction in hours or a reduction in income, they too would allow for the participant to be eligible for this favorable tax treatment or take a distribution from their retirement plan. So that's a very significant change, expanding greatly the number of individuals who will be eligible for a CARES Act distribution or loan. The second thing that the notice did was clarify that the tax treatment of these CARES Act distributions is not dependent on the treatment of it at the plan level. There actually were a lot of plans that didn't adopt any specific changes for the CARES Act and are just sticking with the normal distribution rights for terminated employees or people that have retire or have a required minimum distribution or perhaps a hardship distribution. However, if the individual is in one of those plans is in fact a qualified individual, on their tax treatment, they can still take advantage of that favorable tax treatment. The most important being that they can pay those taxes ratably over 3 years. So from the employer standpoint, it may just be a normal retirement distribution, or maybe the person qualified for a hardship, and so therefore the employer categorized it as a hardship distribution. But if the person is also qualified, on their tax return, they will indicate that and be able to take advantage of the favorable tax. In addition, they clarified that the amount of adverse financial consequence does not have to relate to the amount of the distribution or the amount that you're treating as under these favorable tax treatment. So maybe there was only $3,000 of adverse financial consequences. That still makes that person a qualified individual and allows them to treat $100,000 as a qualified coronavirus distribution and taxable rateable over 3 years, or recontributed to a retirement plan within 3 years. That's very significant. The third thing that the guidance clarified was the treatment of loans. So under the CARES Act, it stated that if a qualified individual had a loan or obtained a loan after the act through 2020, they would be able to suspend those payments for 12 months and extend the end of their loan, which is typically limited to only 5 years, 12 months as well. So now that loan could be a total of a 6-year loan. However, what they made clear was that suspension only applied to loan payments during 2020. The loan payment that is due on or shortly after January 1st, 2021 is still due. So what we're going to see is plan sponsors working with the record keeper to re-amortize those loans, at the end of December or shortly after the beginning of the year, re-amortize, take all the accrued interest that was accrued during 2020 and basically re-amortize that over the new length of the loan, but have the payments begin on January 1st. So again, those are a number of the changes that were created due to this additional guidance from the IRS. It should greatly expand the number of people who can take advantage of its provisions. And so plan sponsors should just be aware and maybe want to communicate some of these provisions to their plan participants so that they can take advantage of them. If you have any questions on this or anything else with respect to retirement plan or the CARES Act, feel free to reach out to your relationship manager at First National Bank and they'll get in touch with us. Thanks.